Today is Brian Wade. Brian is a graduate of David High School, also a graduate of USF. Most successfully without taking any extra time. I've had the pleasure of knowing Brian for more than 10 years. Not only is he a client of mine, he is a friend of mine. Brian likes to work out quite a bit. He likes to play basketball and lift. He enjoys spending time with his family and his sons. But he really just has a passion to help people. That's what drew me to Brian and his expertise. Brian is my financial planner and has been so ever since I stopped doing my own work. As I was Series 7 licensed, I turned it over to Brian, and he's done nothing but help me throughout that whole process. So I'm grateful that Brian was able to join the group. I think he brings such a professionalism, but also fun atmosphere that sometimes is difficult to find with some of our professions. But Brian's an awesome person, and we're really excited to have him here and presenting today. So I present Brian Wade.
Thank you, Craig, and thank you to all of you. I was excited to be able to come here and talk about my business today, and I was thinking, how do I tell these people what financial planning is? Because a lot of people don't necessarily know what we even do. It's complex. There's a lot to it. And I'm like, how do I explain financial planning? And I started thinking, I was like, financial planning, money planning, planning to have money. And that's really what financial planning is it's planning to have money throughout your lifetime. And I can tell you that people who plan their money are much more likely to get a better result in their lives than people who don't plan their money. If I had to break down my business to kind of simplify it and give you the core of what I do, a big part of what I do is helping people save and invest, managing investment portfolios. So if you have to think of what I do in simplistic terms, that's probably it, accumulating wealth. But when you think about what financial planning really is, really the financial planner has to know about so many different areas, anything that would affect a person financially. So we have to know about insurance protection. We have to know about estate planning. We have to know about taxes. We have to know about credit card debt, loans and debts and how they're structured. We have to know answers to questions such as how much money should a person keep in savings? You don't want too little in savings, but you don't want too much money in savings either, because that can be counterproductive. So even though accumulating money and investing money is a large part of what I do, looking at a person's entire financial picture is also what I do. And it is important because if you think about how we can get ahead financially, you've got offense and you've got defense. Offense would include going out and trying to earn more money. And I would encourage you to do that. But we have limited amount of control over increasing our earnings, don't we? I mean, we can try to double or triple our income, but we just have less control over what happens there. Where we have the most control is with what we spend. We have a ton of control over that. So we want to take our money and we want to use it as efficiently and as effectively as possible. So that's what I do for people. Now, why am I qualified to do what I do? And let's talk about this. If you were going to hire an employee for your business, the first thing you would want to see before you interview anybody is their resume. You don't want to waste your time interviewing people until you see the resume. You want to make sure that they've got enough years of experience, that they have the right education, that they know what they're doing, that they don't have a criminal background. But ironically, many people hire financial advisors without looking at the resume first. They pull up and they interview multiple advisors. Well, let me interview 3 of these guys and see what they say. You know, and if they're convincing, if they're confident, if they've got a great personality and you really hit it off, they may get you as a client. I'm here to suggest to you that the first thing you want to know about an advisor before you even waste your time interviewing them is their resume. So let me tell you what I think you should be looking for in a financial advisor. Number 1, in my opinion, independence. Independence ensures that the advisor works for you. They don't work for an insurance company or a bank or another financial institution that has an agenda. When a financial advisor works for an insurance-based firm, guess what they're going to be recommending to you? Insurance. I mean, are they really your financial advisor, or are they an employee of a company that has a profit motive and wants certain things sold? And I know this because I spent the first 5 years of my career at such a firm. And they would say, well, we have all these products we can offer, and you could do this and you could do that. But at the end of the day, those advisors have sales quotas, they have pressure, and they have firms wanting them to steer the client into a certain direction. Think about Wells Fargo a couple of years ago. You may have heard about them in the news, how people that were Wells Fargo at Wells Fargo Bank found out that they had extra bank accounts that they didn't even know about. Why is that? Ever talk to anybody that ever worked at a bank? And I'm not bashing Bank of Tampa, but you can speak to this because you know your industry. You know, you work at Wells Fargo Bank, you're going to have a sales meeting every morning. That's why these people had extra accounts they didn't know about. They have to sign up a certain number of people every day. So when you're looking at the resume of a financial advisor, in my opinion, first thing you want to look for is independent. Oh, by the way, I'm independent. Okay. Second thing you want to look for is experience. It matters. The more years of experience, the more continuing education the advisor has had, the more financial situations he's seen, the more economic downturns he or she has lived through. You know, this last recession was the shortest recession on record. If your advisor has 2 years of experience, so what? I was here during 2008 when people were scared out of their minds. I was here during 9/11 when the stock market lost significant amounts of money for 3 consecutive years. I survived. There wasn't enough money for them to give me a t-shirt. It was that bad, but I survived it. I counseled clients through it. And so experience, 24 years, it matters. And the final thing you want to look for in an advisor, in my opinion, is education. Because if you've got a mortgage license, if you're a realtor, if you got an insurance license, you know good and well that getting those licenses really doesn't mean anything. Most of the tests we take in this business to get investment licensed don't teach you what you actually need to be doing with the client. There's a lot of characters in this business that can say they're licensed. Yeah, I've got 4 registrations myself, plus an insurance license. So what? What you want to look for is education. So with me, I became a certified financial planner. What that means is I had to take 6 college-level courses on various financial planning topics like insurance planning, investment planning, retirement planning, estate planning, and general financial planning principles. I had to take 6 college-level courses and pass the final exams. And then if you do all that successfully, they give you a 10-hour, 2-day final exam that covers all the material. And this is a tough test. Half the people that take it fail. And these are smart people who have studied. So I'm a certified financial planner, and I think that matters. And finally, when you're looking at the resume of a financial advisor, there's a little tool that you can use called brokercheck.finra.org. You can look up any financial advisor you want. You can see how long they've been in the business, and you can see disclosures. Disclosures is what they have to disclose if they have been complained against. Client complaints would be listed under disclosures. Bankruptcies would be listed under disclosures. Liens and judgments would be listed under disclosures. I was on Facebook last week, and this advisor jumps on my post, and he's talking big. I've been in the business 30 years. I took people from $0 to a millionaire. I'm like, okay, let me look this dude up on BrokerCheck. Looked him up on BrokerCheck. 30 years? No, it says 15 years. So if he's been in the business for 30 years, he probably took a 2-year break. Second thing I found was disclosures. Client complaint last year. Owed the IRS $75,000. Is that the guy you want managing your money? He doesn't even pay his bills? I don't think so. So that's what you want to look for in a financial advisor, in my opinion. I think I'm pretty credible. I've been doing it 24 years. I have 0 client complaints ever filed against me. And by the way, you could get a client complaint. It doesn't necessarily mean, you got to look at what the complaint was. But my goal is not to even get a complaint, okay? Even if it's doesn't have a lot of weight to it, I don't want the complaint at all. And so, thank goodness, I have 0 complaints in 24 years. Who do I help? Well, I help a lot of different people. There's a variety of people that I can help. I want to give you a few examples, a few ideas of people you can look for if you're looking to refer me. So one example is the person who, and by the way, how am I doing on time, Craig?
11 minutes.
Okay, great. I was so afraid of, the first time I spoke to this group, they gave me a minute and I took 5. So I was like, I got 20 minutes and I'm going to take 2.5 hours and they're really going to hate me. I'm ahead of schedule, you'll be pleased to know. So let's talk about some of the people that I could help. So you take somebody who has changed jobs. Maybe they got fired, maybe they quit, maybe they got a better job, or maybe they retired. But if somebody leaves an employer, they often have an old 401k or other retirement plan at the old employer, and they may have questions on that. They may need to make decisions on that, and I can help them with that. And in a lot of instances, it's the first time that a person will ever get to work with a financial advisor. I have a client who is 62 years old, and she worked in the title insurance business, and she contributed to her 401k year after year after year, and she got matched. But she never thought of herself as the kind of person that would have a financial advisor. And then when she left the employer, now she has the opportunity to move that money with me, set up an IRA. Now she's got a financial advisor. And you ask, well, what does it cost, Brian? Doesn't that cost a lot of money? Well, let's understand something here. The 401k at her old employer wasn't free. A lot of people think it's free. They're like, oh, well, no, I don't pay anything for it. I just put money in and my employer puts money in. Well, guess what? They've got people answering the phone. They've got a lot of things going on behind the scenes with that 401k. And there's administrative requirements that they have to fulfill on that 401k. Money, it does cost money, and money is being taken out of your money, and you've got to dig in and find the documents. So does it cost more money to move your money to a financial advisor? Sometimes it does cost a little bit more. Sometimes it costs the same to move to a financial advisor, and in some instances, you'll actually experience a decrease in cost by working with an advisor. But 401k plans, by the way, are prohibited from offering advice to the participants. I'm starting to get really thirsty up here. Let me get that water. .401k plan providers are only allowed to offer general education to the plan participants. They're not allowed to offer advice. So they have a group meeting, everybody comes to the meeting, here's your 401k, do you want to sign up, and different risk levels, and da-da-da-da-da, and then they go, well, somebody raises their hand, well, okay, so I'm this age, so should I do that? Well, they can't really answer the question. 401k participants usually get little to no contact from their 401k provider. So somebody leaves a job, it's an opportunity to be introduced to somebody like me. Another good referral for me would be the person getting divorced. Somebody's getting divorced, they're splitting up their assets. It's a time of reevaluation. They're getting half of what they had. Maybe their income is getting split up. What do I do? I've got to start over. It's a time that people seek advisors, and sometimes one spouse may not be comfortable working with the advisor that was helping them as a couple. I just had a situation, a client that came to me this year, and she got divorced, and she called up the financial advisor and said, can I get a copy of my statement? The advisor actually called the husband and asked if it was okay to give a copy of the statement to her. Wrong answer, folks. Her name was on the account. It's a joint account. If she calls up and she wants a copy of her statement, you don't call the husband and ask his permission. You give her the statement. Well, guess what, folks? Now she's my client. And that's part of the reason, you know? So people are getting divorced. Sometimes they want to change advisors. Sometimes one spouse was actually friends with the advisor. So divorce is a moment in time when it might be easier for you to open up a conversation to people about, hey, I know you're getting divorced. If you need somebody who can help answer financial questions, I know somebody that can do that. And then finally, a third good referral for me would be successful business owners. And I would even add to that professionals that are making money, that are doing well. People in their 40s and 50s, let's say. I do want younger clients. Half my clients are baby boomers. I want I need to, as the years go on, I need to keep getting people younger and younger and younger. I just had a couple clients that died, unfortunately. It happens. So business owners, most millionaires in America are actually blue-collar business owners, people that don't look like millionaires. They don't dress flashy, they don't drive a flashy car, but they have a business and they're out competing their competitors and they're frugal and they're just saving a lot of money. Business owners can be great. They don't have a 401k to sign up for unless they create it. They don't have benefits unless they create it. They don't have wealth accumulation. And some business owners think, well, my business is my retirement. Maybe it's part of your retirement. Let's look at what your business is really worth. A chiropractic practice, you can correct me if I'm wrong, but last time I looked at it, chiropractic practice was worth like 80% of the last year's revenue plus the value of the equipment. Sound about right? No? What's that? Okay. Are you going to retire on 4 to 5 times earnings? Yeah. Well, my point is a lot of businesses sell for a multiple of earnings, let's say 2 years, something like that. That should be looked at as a part of your retirement. And by the way, per Patrick, you should probably be thinking several years before you retire in terms of positioning your business so that it's as profitable as possible and bringing in somebody so that you actually have somebody that can buy it and it doesn't become a shock to the clientele or the patients or whatever, and it's more of a seamless transition. So yes, if you're a business owner, the value of your business should be a part of your retirement, but I believe that business owners also have the need to take money out of their business and accumulate personal wealth. It also helps with liability protection too, because if everything you have is in the business and the business gets sued, versus if you start segregating things and you can do other measures that we won't talk about here, but other measures for asset protection. So I think that's it. I feel like I've talked, even though I'm only probably at 15 minutes, I squeezed so many words into that it's really like 25 minutes worth of talking. So I think we're good.
You want any questions?
Sure, I'll take questions. Chris.
You want that scenario or this kind of
General question, I guess.
Suppose you had some money from an account from a 401k you had, you can't really do anything with it, except it exists and it's continuing to actually earn money. Is there a better vehicle to put that in? Would that be a situation where like somebody could potentially contribute that money to a Roth IRA, but then you'd have to take penalty and tax, right?
Yeah, to get it out of, well, the question is if it's in a 401k, we got to find out if it's pre-tax money or after-tax money, because you can have a Roth portion of a 401k, but you could have a pre-tax portion. But if it's in the pre-tax portion and you want to get it a Roth IRA, then the way to do that is to perform a Roth conversion, but that means that you have to pay the taxes on the money that year. It gets added to your ordinary income, so it has to be analyzed based on the person, because it depends on what is your income for the year, how much money are we converting, what tax bracket is that going to be taxed in, and then by the way, Roth conversions are a little bit of a pain in the butt because the accountant has to actually monitor it year after year after year, and you got to be careful about behaviors and things that you do after that. But whether or not you convert it, if you have money in a 401k, you can examine, well, what are the investment choices in that 401k versus what are the investment choices outside. I've actually seen 2 401ks very recently that had very limited investment choices. And I'll break it down for you. You've got target date funds. So a target date fund, you're going to basically pick the year you intend to retire. If you've got 10 target date fund choices in that 401k, and only one of them really pertains to you, that's kind of one choice for you. Then if you've got in your 401k 2 large cap funds to choose from, 2 mid cap funds to choose from, 1 small cap fund to choose from, 1 international fund to choose from, 1 or 2 bond funds to choose from, and this happens. they're kind of dictating, they're not giving you a lot of choice. If you want to make a diversified portfolio and you have one of each category to choose from or two of each category to choose from, they're kind of telling you what the portfolio is. So it's a matter of analyzing the plan and figuring out like what is available in the plan versus what's available outside the plan. And by the way, you got the universe available to you outside the plan, especially if you're working with an independent advisor. Am I out of time?
You have 1 minute.
1 minute.
Quick question, do you do anything with ROBs or rollover business startups? Do you help with that or advise on it?
Are you talking about rolling over a?
A retirement into a business startup?
No, I do not. Yeah.
Got one quick. How about bonds?
How about them?
Good way to diversify.
How about them apples?
Is that a good way to diversify?
Well, bonds are a diversifier because you want items in a portfolio that do not correlate, which means that they move in different directions at the same time. So oftentimes when,
So like stocks go up, bonds go down, and vice versa, kind of?
yeah, oftentimes when stocks go down, bonds may go up a little bit and commodities may go up a little bit. So they are a diversifier for that reason.
How about the mutual funds that are based on real estate? That's some kind of unusual option.
Well,
Funds based on
well,
real
what
estate
about,
investments.
well, what about it?
Is that a good way to diversify as well? I mean, is that something that?
Well, diversification, you know, a good way to diversify is to get into different asset classes that do not correlate with each other, meaning that they move in opposite directions at the same time. Yeah, so real estate, you know, the more asset classes that your money is spread into, the more diversified you are. That's my time.
All right, so we're going to